You were not meant to be a slave to the grind. You were not meant to trade your life force for money. You can escape gravity. You can unlock your life. You got this. Let's go.
Hello and welcome to Unlock Your Life. I'm your host, Jennings Smith. Guys, I'm here with Dr. Eric Francom. He was a dentist, now retired. He owned, operated, and rolled up 4 dental practices, and he sold them to private equity. This guy is in the alternative investment space. He's also doing some stuff with real estate, about 50-50, but he's increased his passive income from $7K a month to 6 figures a month, and he teaches and shares knowledge on how to do that. He's got a small mastermind. It's a Shark Tank, if you will, of high net worth individuals. He vets deals out, brings them to those gentlemen or ladies, and they look at them, put them on the hot seat, and they're able to get a front row track, cutting edge seat to these deals that are just coming to market, right? Where they can have a lot of upside, limited downside, sometimes even protected by real estate. But I wanted to have him on the show so that he could talk about some of this stuff. And there's something on here on his bio talking about George Clooney, Casamigos, and celebrity brands. And I want to get into that too. So Eric, thank you for being on the show and welcome.
It's great to be here. Thanks for having me, Jennings.
Yeah, man. So you're far from the regular dentist, okay? You know, I think of a dentist as a guy that's been over the chair, for 40 years, doesn't really look around and do anything else. And you've scaled this thing into something much bigger than that. So tell us about that. What was the hunger, the drive to do that?
Well, I was grateful to go to dental school. I was grateful to learn about the human body and to have the power to be able to help people. And I did that for almost a decade. I was told to not do a 10-year and burnout career, to pace yourself for 40 years, but I guess I didn't listen very well. So I went with what most of us crave, and that is progress. So I progressed from working for someone else to having my own office to scaling and having 4 offices. And I thought I can either continue on this path or maybe I pivot and let my investments that were doing really well afford me the freedom that I really was looking for, to spend more time with my family, more time in an adventure that I had pretty much sacrificed everything for my job. So almost out of necessity, I went to scarcity type life to an abundant one. And now, I'm making significantly more before I wake up in the morning from passive investments than I did as a successful dentist with 4 practices. So it's been a great transition.
That's awesome. And that's what the show is about. Unlock Your Life, where people, if you're doing something that you love and you're passionate about, that's amazing. But there's so many of us that we want to get that freedom back, right? We feel chained to something that just isn't our identity and not what we want to do anymore. It's not serving us anymore. And I think a lot of people are scared to do what you did, though, because your identity probably was wrapped up in being a dentist to some degree.
Yeah, fear is what really does tie us into a lot of bad decisions. And, even for a lot of loved ones, it was very nerve-wracking for my wife.
I hear you.
Family, different people that are just like, what are you doing? Like you're going to put my grandkids at risk or whatever it is. And, I certainly had to do what I wanted. And I'm never afraid to ask the question, why? Why am I doing this? And if I can't answer, a really good answer as to why I'm doing something, I'm not afraid to pivot into a bigger why.
For sure. So tell us now, you scaled up the companies, I assume, or the practices, you sold them, and that gave you some runway to jump into this, or were you doing this in concurrence with the practices?
So I was investing before. I couldn't have just completely exited dentistry without having the passive income to do that. It certainly grew exponentially when I had more time and ability to network, to hire even more of the best coaches, and for me to attend other masterminds. I've spent millions of dollars to get the best coaches to really shorten the distance of how long it took me to get to where I am. And now for my private clients and my mastermind, I pass along that knowledge in addition to what I've gained through experience at just a fraction of the cost. So those are the most valuable things I've had, are my network and my knowledge. They're much more valuable than just doubling your money. And when you have the white space on your calendar to do that, opportunities just arise.
Hey, I mean, where your attention goes, that's what grows. That's where the dollars flow. And that's what's so critical, is if you are chained to a job, if you are chained to a career or something that you don't necessarily want to do, it's okay but you got to dedicate a little bit of attention and focus to the future, to let me see where I can get 2, 3, 4, 5 years down the road versus just head down 100% focused on this one dental practice or this one construction company or wholesaling the next deal or being a realtor and listing in the next house. Like before you know it, 20, 30 years have slipped by and you never built the empire that you wanted to build.
Exactly. And or you never built the relationships that you wanted to have or had the adventures that you wanted to have and all of the above, like I still ask myself why, and I have to ask myself why, because I still have to say no to great opportunities so that I can be in good balance.
Exactly. Because it's easy to, and I did not understand that. I would say 6, 7 years ago, I didn't have a whole lot of opportunity coming my way, or I didn't know how to recognize it. Now it's like I've got to say no to 90 something percent of it because I've got to stay focused on what I'm doing, especially with all these podcasts I'm doing. I'm like, oh yeah, I should get into, that. I should get into car washes. I should get into land flipping.
Yeah.
But you got to stay focused. That's a good problem to have so much opportunity. Now you mentioned doubling your net worth, and you did that for 2 consecutive years. What does that mean? And how did you do that? Like, are we talking you doubled your net worth from 100 grand to 200 grand, or what are we talking?
No, I mean, it used to take me a lot longer to double my net worth, except for, when I was a 15-year-old kid with $20. That was a little easier. I just had to work for 4 hours. But once I had more of the courage, let go of the fear to leverage what I already had and change from a scarcity mindset to an infinite mindset that I call it. It's even more than an abundance mindset. The infinite goes on forever, even long after we're gone. Our net worth and everything can continue to pay dividends to others. So by having the infinite perspective and infinite mindset, instead of having real estate that I owned outright, thinking, hey, I'm just not going to leverage this at all. I'm going to let that money sit here and just make me thousands of dollars a month and, just really protecting for the downside. I made calculated risks to turn that into a significantly higher amount of cash flow and net worth. I bought into some investments that were worth more than double what I paid for them from day one. And those are paying me more than just that money sitting in a checking account or in the walls of my real estate was paying me. And so, you can't find deals like that on the public markets. You can't buy a stock that's worth really twice of what it is in today's value because it's so efficient. There's the smartest money out there with the smartest tools and the artificial intelligence and just all of these little micro unfair advantages. You can't really beat the stock market. But in the private equity and venture capital side of deals, there are unfair advantages because people can't do enough vetting to vet every single deal, as well as being in a sweet spot below the size of like a BlackRock or some of these big companies. They don't write checks as small as what we're into, but there's also few people that do write those checks because you have to be an accredited investor and few people want to do it on their own compared to letting somebody like a BlackRock do it for them. So we find amazing investments that have downside protection that we can negotiate for personal guarantees and, really de-risking a deal that has huge upside.
Break one of those down. Can you break one of those deals down for us and give us an example with, how did you mitigate the downside? What industry was it in? What kind of numbers or what kind of purchase was it? Can you give us an example of one of those deals?
There's 2 that come to mind. The first one is, you talked about that Casamigos thesis example with George Clooney. So, there's a fund manager that just has some of the best relationship with A-list celebrities in the United States and the UK. And, she leveraged her relationships to help them, these A-list celebrities, to be partners in a company rather than just celebrity endorsers. So somebody could make millions of dollars endorsing Pepsi and some of the biggest companies in the world. But like George Clooney said, no, I'd rather have the stock in the company. I believe in this product. You don't need to pay me anything. Maybe I'll even pay you money to invest into it, but you're giving me preferred terms because of who I am and additional stock. And then Casamigos sold for $1 billion. George Clooney ended up with about 400 million of that $1 billion exit. And the other celebrities looked and said, hey, I want a part of that. I want that setup rather than just trading my face for a temporary, little bit of money. So there are several investments that were partnering with people like Oprah, Justin Timberlake, Tim Tebow, Serena Williams, Jennifer Aniston, Shawn Mendes, just people that have partnered into this format. And first of all, that's one of the best ways to grow a company anyways, because any new products that we buy probably are associated to a celebrity, unless it's like a Sony or something that's been around for 100 years. Then people don't watch advertisements much anymore. A lot of their social media following can be one of the biggest sources of advertising. This is how younger people are buying, and younger people that have more and more money each day. So basically going into that fund, they had already had an exit that they didn't distribute out to their investors. And by investing into that fund from day one, my money was worth twice as much as it was because I negotiated to not have a catch-up fee, which is kind of common. If you're coming in a year and a half later than somebody else, I negotiated for my money to be treated the same as somebody that took a risk on them much earlier. And that's the kind of thing I do for my groups. So everybody in my group that came in, their money is worth twice as much from day one.
Okay. And so what's the liquidity on that, though? Is it got to be waiting for an exit, or
Yes.
how long is the tie-up?
Typically it will be in distributions. On average, you get at least 4% more for an investment, 4% a year more on an investment that is not as liquid.
Right.
So there are certainly liquid versions that we have. They don't pay as well. But in something like this, there are things that you could do. I could sell my share that's gone up by double. I could share that on the secondary market for probably 70 cents on the dollar. So I still would be up about 40% on my investment immediately, selling it to somebody at a discount. Or as these companies more and more keep getting sold, within about 2 to 3 years, I go into investments that within about 2 to 3 years, I get my original principal back, and then I'm playing with the house's money beyond that. So,
and you get those back through monthly distributions or quarterly distributions?
It's not monthly in this. There are several deals that we do that are calculated monthly distributions, but in something like this, it's based on when the companies exit. So we're buying into companies, and usually after years 2 and 3, we start having an exit on some of them, but years 4, 5, and 6, that's usually where the big exits are going to take place. So that's where you get your multiples on investment as opposed to just incremental gains.
Gotcha. Okay. So this was a fund that was set up. You were connected to the guy. They had made deals with 5 or 6 celebrities, and each of these celebrities is either starting a company or partnering with an existing brand as a part owner, right?
Exactly. So there's about 7 right now, and we're going to grow to probably 30 brands before the fund is completely there. So there will be some that are being sold while there's others being certainly purchased. And it's about freedom and lifestyle as well. So not only do we invest in something that is good, but our limited partner retreats are on Necker Island with Richard Branson and several of the A-list celebrities. So it's fun to kind of rub shoulders with some of the people that we're invested with, and to play tennis. I might only, if Serena Williams ends up coming, I might have to go to pickleball because I don't dare play tennis with her. But it is nice to get to know some of these celebrities and their networks, because again, your network and your knowledge are everything.
Absolutely.
Yeah. Could I give you one more example too?
Yeah,
of downside protection? So there's a company that I invested into about a year ago, and it has some real estate that was given to it by a city and state that wanted to attract the hard technology that it's helping to build. They said, California is having all the fun. We want to bring that into our state. We want to, incentivize you guys to do this. So they were given a 300,000 square foot building for $1 a square foot is essentially what they ended up paying after all of their build outs and everything. So they turn around and they have it fully rented out at $110 a square foot. So their clients are already paying them, and they're making millions of dollars a year on just their rent. But then their clients are also paying them for their access to their engineers and for all of their their 3D printers and the different things that it doesn't make sense for one company to have those things. It would be too cumbersome, but they can have access to a huge array of them. So they turn away about 92% of their applicants. So they're always full. They're always going to be full. They're actually scaling to have multiple locations where somebody else takes the risk on the real estate, and they replicate this model. So they have a very protected downside. This lease was valued at probably about $70 million, now adjusted for this little bit of inflation over the last year. And the asking price to get into the fund was about $75 million. So right there, in a fire sale situation, they could turn and sell this lease to a Google or some of the other big companies that allegedly have been even inquiring on it, and the investor is quite protected. Now, on the upside, of the 8% that came in here, they're going to take a very small percentage of that, about 8% of the 8%. They're going to partner with them and say, hey, we think that you're going to become a next unicorn type company, but we're going to charge you, 20 to 25% of that growth to partner with you and help you to get there. So they literally could be taking these companies that are worth thousands of dollars as they come into them and bring them up to, $1 billion companies, all while having the bottom downside risk paid for. So that's a good hybrid type of investment. There are a few of those that have downside protected by real estate with unlimited upside.
Right. I did a job for a guy who built one of those type scenarios in Charleston, where it was a half parking garage, half tech incubation space. And it was like little mini offices, and they would lease them out, but you had to be in the tech space. And they got some tax credits from Charleston because Charleston wanted to attract the tech component. And yeah, it was phenomenally successful project. And what they're doing is almost like a incubator, like a tech incubator place, right?
That's exactly what it is for hard tech. And yes, I mean, they're making the world a better place. I mean, they've created it out of necessity during COVID. They created respirators that only cost about $4,000 or $5,000 to make. They were told it was impossible, but they needed to do it. They dug into old patents, created some of these solutions that saved just thousands and thousands of lives.
Well, that's the thing with those startups. Is like, you hear, oh, wow, you could have bought into Twitter, or you could have bought into Amazon. But, for every one that we hold up as like, this is the unicorn, there's 1,000 that never worked. And
Absolutely.
So I think that the downside mitigation on those, especially for somebody like me that doesn't really understand tech and how valuable that stuff is, that would make it a little bit more of a comfortable thing of knowing that, hey, well, they got this real estate at a great deal. They've got phenomenal lease terms. I can calculate the cap rate on the leases, and I can know that it's worth $70 million. And the fund is valued at $75 million. I'm buying. So my downside is 7% or whatever it is.
Yeah. I really look for those that have the downside protection. That's the biggest thing that helps you to multiply your money in a shorter amount of time. The bigger guys, like the BlackRocks, they have a ton of pressure put on them to deploy a bunch of capital in a pretty short period of time. And their appetite for loss is much higher. They will invest into companies knowing, hey, 90% of the time this company is going to fail, but the 10% is going to overtake, the 90%. But
right, so those tails on the distribution curve, they make up all of it,
Exactly.
all the profits. So what about, I've gotten into some stuff, right? I mean, we're all opportunists. We're all the same. My listeners, I mean, we're talking about multifamily and real estate mostly and passive cash flow. But what we want is that passive cash flow. We want the freedom. We want the income. And so we hunt opportunities, and I've hunted opportunities that haven't worked out so well, right? When I've strayed out of my lane, and they seem amazing. Some of them have worked. Some of them haven't worked. Tell us about some deals that have gone bad and what you learned from that.
Yeah, I mean, there are deals that can go bad. There's one that was in an e-commerce space that bought up a bunch of well-known brands that they were trying to grow too fast by paying an unrealistic distribution. And, that's something that I had some other kind of trusted friends that had gone into that investment. And one thing I learned is, don't lower your own guard just because a trusted friend is into something. Do your own due diligence and look at it without emotion. Emotion gets us in a lot of trouble when we're having a fear of missing out of something.
Was that the Ty Lopez's fund?
Yes, exactly.
I had an investor who he invested in the pet company, but he said in the legal docs, he was reading in the fine print, and they were allowed to raise capital, bring capital, and pay the preferred returns to the prior investors, with the new capital that they're raising. And it's like, he didn't feel comfortable. Yeah, but I mean, they were paying crazy, I think 15 or 20% preferred return on those deals.
And even higher on some, depending on how much, people brought in. It started off as a really good thing where they bought, a company that they charged their clients they paid 20% on a secured deal for a low valuation on the company. And then they just, continued buying companies, but it wasn't secured. It was, bigger. It just got out of control. So it got to a point where it's not sustainable. And you ask, kind of what you learned. I mean, sometimes you learn the things that you already know, but you're like, okay, hey, this is something that don't go against your gut. I mean, when has your gut ever been wrong? And that's one thing I've heard from investors there that are just like, like I kind of went against my gut. There was other people that I knew that went into it. And there's several investors that are just, learning a lot of lessons. But yeah, I will never invest in something that pays out in the same round that it's raising money. That is certainly a huge lesson. And that's why it's difficult to get great cash flowing investments, is because you're getting that payout at a later time.
Yeah. You said something that I thought was really key was, just because a trusted friend is in it doesn't mean it's a good deal. Just because somebody that you trust is telling you this is a good deal, I mean, it's a good start, but I have been susceptible to that. Something I didn't really understand very well, but somebody that I trusted or knew was saying, oh yeah, I'm in it. It's great. It's great. It's great. And so you kind of get lax. And I have people that call me and want to invest, and they're kind of like, well, if you say it's good, it's good. And I mean, I appreciate the trust, but I want them to understand the deal for themselves. They need to understand the fundamentals, and everybody's got to make their own decisions with this stuff.
Yeah, exactly. Just because someone else lets their guard down doesn't mean that I will. And I tell that to my clients as well. I've gone as far as I can with some, and, they say with art, it's never completed. It's just abandoned. Like Michelangelo just had to stop his Sistine Chapel at a certain point. It's kind of the same with vetting. It's not completed. It's just abandoned. And you can get as far as you can, but at the end of the day, you can't vet somebody's heart and their mind and their soul. But there are a lot of things that we can vet, track record. We can vet a lot of the things that are the big ones. And so having a thesis before you even see a deal really helps to not get emotionally tied to it, because you already know what you're looking for, and you can filter out something that doesn't meet that. And then one of the biggest things that I do was I bring more deal flow, of good deal flow, to my group than they could possibly handle. And that way they are the buyer. They're not thinking, oh, shoot, I'm going to miss out on an investment. They're thinking, hey, make me an offer I can't refuse. Let me know why of these 30 deals I should invest in you. And I tell them to look for an excuse to say no. And if they can find that excuse, to stay away from it, because there's so many other good ones.
So tell me about your group. I assume it costs money to be in the group. And then if for this group to be useful to me, what do I need to have in investable assets? And how are you getting compensated for this too?
Sure. So, I mean, I'm an investor. That's where my money comes from. I really enjoy helping people. I'm a collaborator. Yes, I do get paid for my time to do that. But my biggest income is going to continue to be from my investments. And people that are wanting to learn how to do that, yes, there's a cost to be in our group. And it makes sense if somebody has about $60,000 to $65,000 to invest.
Oh, wow. I was thinking a couple million. Okay.
We do have people that pay millions in taxes, and we have investment strategies that helps to pull that down, because sometimes that can be the best investment you can have, is getting your taxes way down. But there are deal flow that is good enough that, yeah, even including the fees for the mastermind at about 60 or 65,000 to invest, it would much more than pay for itself, not to mention the education and network that you're getting, because I'm showing people how to do this. I'm giving them my networks, making connections.
And what does the mastermind cost? What are the fees?
So, typically don't go over that part as much. I let my team go over that. But as far as if they do have around, 65 or so, it does make sense, including the investment that they're going into, that they're still going to make likely certainly a multiple on their investment, not just an incremental percentage return.
Gotcha.
So we do have a little bit of because I used to do this more on an individual basis, but we've been able to help more people when we do it with the group. And so we do have a little bit of an incentive for people to come in if they want to. They can certainly reach out, to my website and that kind of thing, and hop on a call. I'd be happy to hop on a call one-on-one to see where we can help, whether they choose to join or not. There's also some free resources there too.
And now, are these companies that are pitching, are they compensating you to be able to pitch to the group?
No, that's something that I ask to the terms that I negotiate. I want to negotiate to the group, and there are some things where I'm creating a fund and doing some other things that some people don't want to be as involved, where, I'm putting together a fund where that fund will take a percentage of the profits after everyone's been paid their money back with profit. That fund will take part of the profit for managing it. There's a lot of hard expenses for attorneys and different things. And so there are options there. For people that listen to me, I typically recommend just do it yourself. I'm teaching you to do this yourself and to see what to look for. But yeah, my compensation comes in the form of just like tuition for the mastermind that pays for our expenses and our different things. And yeah, that's the setup that we have. So, you're not paying like a percentage of what you're making like you would with a typical advisor. So people that are putting in, a few $100,000, I mean, it makes a lot more sense to make a huge multiple on investment.
Yeah.
And you only paid one flat fee at the beginning.
Well, and I was kind of hoping you would say that because it seems like it would be a bit of a conflict if you're getting compensated as a capital raiser, right? Where you're getting 2% of everything you raise and pushing it to these companies. And so you kind of just want to raise as much money as you can, and the deals don't have to be that good. You're just trying to get volume of deals, right? Like that starts to, I'm not saying you can't have your integrity intact with that, but you're not incentivized to pick and choose only the best deals.
Another thing is I don't really bring a deal to my group unless I'm invested, with my own money. Unless there's maybe a tax thing that I'm not needing that particular year or something, I'm putting my own money with where my mouth is. And oftentimes I have worse terms for my own money, such as I may have to have a higher minimum as part of my negotiation to get a company to lower the minimum investment for our investors. That type of thing.
And is this accredited investors only?
It really is. Yeah. So it doesn't make sense. If somebody's not an accredited investor, I mean, they could come in the group. It's still great learning and knowledge and networking. There's some people that are on the cusp of it. Some people I've had that make good money and have some to invest, but aren't quite to the accredited investor status of having $1 million investable income or, $200,000 to $300,000 a year, depending on how they file their taxes. They have gotten their their series 7 or their series, their 63, that they can basically legally do that, even if they're not accredited. So that is more rare, but it makes a lot more sense if you're accredited because all of the investments, with very rare exception, require that.
Yeah, no. And there's a lot of multifamily deals like that, unless you get the personal relationship. But if they're out there soliciting, I assumed it was accredited only. So now if people go to Eric Francom, FRANCOM.com, what are they going to be able to do there?
So there are some free resources there. I dissect a few more deals than we have time for on this call, where I talk about, some of those investments that are an example of how you can get cash flow and different things. I talk about some of my principles that I'm writing my book about, which is also going to be coming out. And you can also schedule a call, with myself to be able to go through your situation, kind of see where I can add value and see if it's a right fit, if it's something that makes sense for you to come in and join, because I really don't let my clients fail. I take that very seriously, and I want to make sure that we're bringing the right people in and that they have the right, mindset and the abilities to join. So yeah, if people schedule something on my Calendly, I'm more than happy to hop on a call with them. And I just love contributing and sharing, the information that I, have been blessed with.
All right, guys. Well, there you have it. So if you're looking for deal flow, if you're an accredited investor and you want to learn, I mean, it sounds very intriguing to me. I may book a call just so I can find out how much the mastermind cost. He won't reveal it, guys, but I tried.
It's going to be going up to, a little bit soon. And that's partly why I wanted to kind of keep it. But we are reserving the, more the introductory, the founding members fee that's not going to go up even when we do, optimize our prices. Gotcha. Hey, do you mind if I leave you with one encore though before you wrap up, man. Jennings? Just for
sure.
I'll do the sum of dissecting that deal. So there's a pharmaceutical company that doesn't have any debt on it that has taken some investors on later in the game because they wanted to continue to scale. It's very uncommon for somebody to not have debt, but their margins, because they've had that mindset, are so high. They make about 58.5% profit from what they're doing. So they also don't want to take on, big bank lending and that kind of thing. And they're okay having investors take a higher percent, especially since they're paying out of a large percent. They have large contracts of 10 years and whatnot. And again, the real estate's owned outright. So they have decided to pay about 28% per month. And that actually has ranged up.
You said per month, you mean per year?
So annualized, 28% per year, paid monthly.
Gotcha.
So, but we negotiated with our group to increase that to 36%. So on a $100,000 investment, you're getting paid 3% of the total investment every month. So $3,000 a month coming through for a total of 36% if you don't count the compounding of investing that back into that deal or a different one. And then by investing into that real estate and them growing, they're going to sell the package of their deals for a lot more than any one costs to build. So we project that it will be another about 3.5 times return on investment over about 5 years, roughly. So it'd be about 100% year over year gain on your cash, but you're getting a lot of that up front. So that's the type of a cash flowing deal that's protected by real estate on the downside, but it pays a large amount in cash flow on the upside.
Yeah, I mean, that sounds amazing, but it also sounds like they don't have a CFO. Like why would they take on debt at those, or not debt, but why would they take investment in that terms instead of, it just seems like a super expensive way, or they just don't want the risk of having debt that they might default on? What is the motivation of that? That makes no sense to me.
There is some red tape in some of the pharmaceutical, industry and that kind of a thing. So there are some red tape that make it more challenging for them to get debt.
To get
but
lending,
also,
okay.
They want to keep more of the equity. They would rather give more of the
cash flow.
Yeah, exactly. They'd rather give more up front than giving away the farm. They'd rather give more of the harvest than giving away the seed corn, essentially.
And I've done that. I've structured deals where we've paid 15%, paid monthly, mezzanine debt. And it's like, why would you do that? Yeah. Well, because I want to keep more equity. Or I've done a 10% preferred return, but only given away 20 or 30% of the equity of the deal, because I know my investors need to make 15 to 22%, or they're really not going to be attracted to my deal. And so how do I do that without giving away the farm as far as equity goes? So I get that, but yeah, that's pretty incredible. Now, is that fund still open? Are people still able to invest in that, or is that done?
It is. So there are some terms. I mean, it's looking like if they're going to be doing another one for their next build, and I guess their CFO's gotten involved a little bit, and it's going to be going down a little bit for that future round, but it is still open as of now to finalize, the current building that they're building right now.
Gotcha. Well, cool. Well, that sounds exciting. And that's where the relationships do come into play of knowing somebody. Okay, Eric's got the preliminary vetting on this. I'm going to do my due diligence. I'm going to look into this and see if it's a right fit for my risk portfolio and what I'm doing. But hey, I love it. This has been a super intriguing and interesting show. I know my audience is going to love this one. I'm excited to release this. So guys, head over to Eric Francom, Eric, E-R-I-C-K, Francom, F-R-A-N-C-O-M.
Just E-R-I-C. I'll catch you there.
E-R-I-C. I'm sorry. Yeah. EricFrancom.com. You can grab, you can look at his one-on-one coaching mastermind. You can book a call with him. See if you're an accredited investor, if this is something that you want to connect with him on. So, Eric, man, thank you for being on the show. I really appreciate it.
It's been an honor. I appreciate it, Jennings.
Yeah, man. So, out there listening, appreciate you giving us your time. It's our most valuable resource. So, make sure you utilize this week, some part of it, to focus on what matters and to unlock your life. Peace.
This is thepodcastfactory.com.